Good morning, good afternoon, good evening, wherever you are and whenever you're listening. I want to congratulate you on taking the steps on bettering yourself and being the professional in your field. My name is Hunter Boyd. I'm the Director of Sales for the Share Realtor team, and this is Mortgage Mindset. Today we are joined by Chris Brazel. What's going on, Chris?
Hunter, how you doing, sir?
Doing well, man. Director of Operations for the Share Realtor team. Very excited for what we're going to be discussing today. We're actually going to be starting our first series, and this series is going to be on non-QM products. So things like DSCR, bank statement loans, 1099, asset qualifier, just all those things. Chris, why don't we just kind of jump into what does non-QM even mean?
Yeah, it's a good place to start because we use all this terminology in the mortgage world because we deal with it every day. But a non-QM loan, basically what that means, QM is short for a qualified mortgage. And what that means in layman's terms is that it's following conventional conforming guidelines to become a qualified mortgage, to qualify under Fannie Mae, Freddie Mac, FHA, the normal loan programs. So a non-QM loan is a portfolio loan. And what that means is specific investors have expanded the guidelines and they're going to lend the money on a loan program that they've developed and they're going to portfolio it themselves. And what that means is that they don't plan on selling this loan on the open market like a normal mortgage commodity.
So if it goes upside down, they're going to collect on it. They're going to be your collections department. They're going to, God forbid, they're going to foreclose. They're going to really take this thing from origination to paying off the mortgage one way or another.
That's correct. Yeah. The way to think about it is this is a hard money loan, but it's from an investor and not hard money, somebody you're getting off the street that, it's a way of getting things done, but this is a little bit more, I guess you would say, in a tighter box than a hard money loan, but it does not have the normal guidelines of a Fannie Mae, Freddie Mac loan.
So it does kind of remind me of a pre-2008 type loan, where the package is maybe not as complete. Maybe there's lacking income in the package or something like that. Is that, is it pre-2008 why we have that today because of what happened back then?
That's correct. Yeah. So back then, I started in the business back in the early 2000s. We called it the Wild Wild West back then. It was a lot of fun. It's very little regulation, but we had no doc loans, stated income, stated asset. Basically, the saying was, if you could breathe, you could borrow. Meaning we pulled a credit report, and if you had good credit, you're going to tell us how much you made, you're going to tell us how much money you had in the bank, and you're going to pay for it with a little bit higher of an interest rate, but you're going to get a loan. And so that went away when we had the housing crash in 2008. The government came in, swooped in, Frank Dodd Act, and they said, we got to tighten up the mortgage industry. Of course, we took all the blame as mortgage originators.
Sure.
Not all the blame was on us.
I saw The Big Short.
Yeah, I still have PTSD, man. I mean, that was a tough movie to watch, but it was pretty spot on. It was a lot of fun back then. And I'll tell you, we did need some regulation in the industry and kind of weed out the bad seeds, but it did go too far. I could go down a rabbit hole and tell you about things like that. However, so it all went away and it got so hard to lend to people, and the people it affected the most are the people that do have non-conforming income. Your regular salary W-2 employee, they're like, fine, I'll give you your W-2s that you need and things like that.
They fit the mold that, Fannie and Freddie want to see.
Exactly. Where less risk adverse.
Right.
And so what happened is these investors came in and said, they tightened up the mortgage market so much, it left out a big part of the population that should be able to get a mortgage. They pay their bills on time. They make good money. But guess what? They may use the tax laws that are out there to offset their tax liabilities. There's rules in place for them to not have to pay hand over fist just because they're self-employed borrowers. And it's not to punish them from the IRS standpoint. However, the IRS was not in cahoots with the mortgage industry because the mortgage industry wanted everybody to be a tight little box, meaning we need to show what income you're claiming and paying taxes on to the IRS in order to get you qualified. Well, that's not the true picture. We all know that's not the true picture. Right. I mean, most of the people listening to this podcast right now, if you're a realtor, you don't claim 100% of your income because why would you?
Right.
Because then your income is going to be offset by the amount of taxes that you pay. So you're being eliminated from qualifying sometimes from these, the QM loans, the Fannie Mae, Freddie Mac conforming loans. So it fits a need. And it's not to be thought of as like a, something that's a bad loan or something that should be looked down upon. It's a loan that was put in place to fit a need that went away when the industry tightened up so much.
So you mentioned realtors specifically.
Mm-hmm.
Who else do you think these types of loans help? I would think, if you're mentioning realtors and 1099s, you're thinking, self-employed borrowers, things like that, right?
Yeah. So it's going to be any of your major entrepreneurs, people who open up a business. Maybe they own a small shop, restaurant owners. We've done quite a few of these for like nail technicians.
That's exactly right.
Your people that are 1099 contract workers, things like that, they don't have the normal W-2 job where they're paid, $90,000 a year in salary. They make money, maybe, like a therapist or something like that, or, somebody who does like, physical therapy and things like that. They pick up their own clients. So they may work at a particular, hospital or outpatient facility, but their income is based from their own clientele that they pick up. And so they're paid, on an hourly rate or, a billable hour rate where it's not normal. And so they get a 1099 from their employer. And so they file, Schedule C like they have to. And they write off their expenses because they're allowed to.
That's right.
Yep. And so, your net income is not a reflection of your actual income in these type of loans, but your net income is what you want to report to the IRS to limit your tax burden, which is why those rules are in place.
Yeah. I would also think that like products like DSCR, that's going to help somebody who maybe doesn't have a ton of qualifying income,
Correct,
but has a heavier cash flow, right? Like maybe maybe they inherited some money or something like that, hit the lottery, hell. And, so they have money for, a 15, 20, 25% down payment.
Yep.
And they don't mind, eating the higher interest rate on that mortgage because they're not the ones that are going to be paying anyways. The person who's renting the property will be the one paying the interest rate.
That's right. And investors, that's exactly right. People that are investing and building their own personal portfolio, maybe they own 10 to 15 properties.
Yeah.
And they're, not only are they making money off the rent, but they're making money off the equity that they're building in the house. And this is their retirement plan, which is a great way to do business, especially in this market. And so those people, they would not qualify for a standard Fannie Mae, Freddie Mac conforming loan. Mm-hmm. And that's why these loans are in place. It allows them to expand their portfolio by purchasing more properties. And at the same time, they get the loans that they want because they know they're going to make the cash flow off the rent and they're going to make the equity off the appreciation in the house.
That's it. All right.
Yeah.
So let's say Agent Joe has gotten his client Susie under contract. What can they expect as far as like a turn time? Like, are we talking, we love to tout our 15-day close on a conventional FHA.
Mm-hmm.
We talking 15 days here? We talking 60 days here? We somewhere in the middle? What are you seeing for most of these non-QM products?
Yeah, somewhere in the middle. We're going to be about 30 to 45 days.
Okay.
And what that takes,
yeah,
it's not bad still. So it's not like, I'm not saying anything bad, like credit union 60
I'm about
days.
to say, should normal pre-qual from the local credit union.
That's right. But what we do is, because these are portfolio loans with investor specific, they write their own guidelines. So we can't just go to Fannie Mae handbook and look up, hey, does this client qualify? Ideally, we get the application in, we get some of the supporting documentation in that we want to look at. And the first step in this process is we want to send it to that specific investor. The investor is going to take a look at it up front. They're going to give it the green light. The green light's not a full approval, but it's basically, that's our version of a pre-qualification on these non-QM loans. Yeah. And so they give it the green light. Then we send it out and say, okay, look at, you're pre-qualified. Why don't you go out and find the house and go do what you want to do at this point? And then once you're under contract on the house, that's when we start the normal underwriting process. But everything does have to go to the investor because these are investors lending their own money that they're going to service on the back end, i.e. the portfolio aspect of it. And they have no plans of selling this on the open market because they can't. They're going to be the ones to underwrite it as well. So it's a little less control than your normal conforming loans because we do everything in-house on those.
Let's say it sounds very much like a lack of control there. Yeah,
that's correct. That is absolutely correct.
You're at their mercy.
We are at their mercy because they're the ones giving us their money because they're the ones taking the risk on this to take it on as their a commodity in their own portfolio that they're going to service long term.
Well, and selfless plug here for you, but like that's why you want someone in your role where your job is to stay on that investor. Hey, look, we're waiting for an update here. We're waiting for this appraisal to come back. We're waiting for this underwriter to review this stuff. Having someone as a director of operations who's if it's taken, you said 24 hours, it's hour 25. We need an update. That is something we're going to need to see very quickly. I mean, I think the individual loan officer out there, while they can benefit from this, they have to be very diligent in monitoring these investors because there is a lack of control. And had not, asked not, squeaky wheel gets the grease. All that stuff is very applicable in this situation.
Yeah, that's correct. That's why we have built the relationships with these account reps that are with these investors. The relationship is key with this because that's the go-to person for me when I haven't had an answer in the time frame I expect, because we set high expectations for us to present to the realtors, to present to the clients that we service. And we do set the expectations on these accordingly, that it's not like our normal conforming loans, but we still have expectations to meet and people need answers. And what that means is I go to the account rep and demand, answers and accountability, which it's good because it's a symbiotic relationship.
That's right. They want to appease that, right? Because they want the continued business. There's not just one non-QM investor out there.
That's right.
I can go to many. I can develop a new relationship if I need to. But, if your rates are in line, your guidelines are in your line, and your conditions are not insane, I want to keep the relationship I have because we already have kind of started this path together.
That's right. And the good thing is once we learn the process with the particular investor and account manager or account representative, then we know the next one we should expect the same. And it becomes, a normal flow of doing multiple loans with them. And if their parameters change at all, we need to know up front and relay that information because these do kind of ebb and flow a little bit because the products are so unique. Sometimes their guidelines change. And so our account reps tell us up front, they send out email blasts and kind of keep us, apprised as to what's going on with these loans, if anything changes. And that way we know what's going on with these products from beginning to end.
Yeah. All right. So, before we end the show today, let's kind of real quick just hit some of the top ones we're going to be going over. The next 3 weeks, we're going to be referencing these, going into more detail. With next week, we're going to be starting with DSCR products. This is one of my favorite products just because I deal with a lot of investors, buying first, second, third investment properties, having this type of loan. Essentially, it's a pre-2008 no-doc loan where you use the rent schedule from the appraisal as qualifying income. We're going to be going into more detail on that next week. The following week, we're going to be talking about bank statement loans, asset qualifiers. You got anything you want to put on those?
Yeah, so those are great loans for those self-employed borrowers.
Yep.
To see, it's almost like a P&L through a bank statement, but we will go into those a lot more detailed, of course, in the second week, but they're great loans for those self-employed borrowers that will show a true picture of what they're bringing in without having to hit them for the write-offs or depletion or anything like that, the expenses that they write off on their tax returns.
Yeah, and then last week, we're going to be going over 1099 and P&L profit and loss statement loans. What do you got to say on that?
Yeah, so those are great products for, again, those contract workers and people that, they are, for all intents and purposes, self-employed, but maybe it is that nail technician that works at a salon, but they bring in their own business, that physical therapist and things like that. So again, it's somebody that's paid 1099, or they just have a P&L on their expenses because, they bring in a lot of money, but they do write off of money. But the P&L, they're looking at the cash flow. But again, we'll go into that a lot more. But it's, again, a good product for those self-employed borrowers.
That's right, man. Look, if you've enjoyed today's show, if you're looking forward to the next few weeks and where we talk about these different products that are out there for your clients, go ahead, hit that like, hit that subscribe. Remember, you be the professional. We're going to be here to help you be that professional. This has been A Mortgage Mindset. Tune in next week for DSCR and all things that come with that program. Thanks. Mortgage Mindset Podcast is hosted by the Sherry Riona team at Clear Mortgage, powered by City First Mortgage Services, LLC. Sherry Riona's NMLS ID is 71774. Visit us at thesherryrionateam.com for more information about our team. The opinions expressed on this show by the hosts and their guests are their own and do not necessarily reflect the views and opinions of Clear Mortgage or City First Mortgage Services. Please note that Clear Mortgage is powered by City First Mortgages, LLC, and their NMLS ID is 3117. Clear Mortgage and City First Mortgage Services is not an agency of the federal government and is not acting on behalf of or the direction of HUD FHA. City First Mortgage Services is an equal housing lender. Programs, rates, and terms subject to change without notice. Underwriting terms and conditions apply.